CPI and NFP explained for morning notes. Catalyst Briefings. Welcome. Today we're breaking down two macro reports that can move markets in seconds: CPI and NFP. These prints often trigger sharp moves in stocks, bonds, and currencies right at the open. Why? Because they shape how investors expect central banks to set interest rates. A hotter number can mean tighter policy. A cooler one can bring relief. Traders also use these releases to set a morning bias. Are we buying dips or fading bounces? By the end, you'll know what to watch, how to read it quickly, and how to turn it into a clean, confident trading plan. CPI measures price changes, but there are flavors. Headline CPI includes everything. Core CPI excludes food and energy, which are volatile, to reveal underlying pressure. Timeframes matter too. MOM, month over month, shows the speed of change, while YO, year over year, shows the trend. Markets care about both. A hot print, especially core, signals lingering inflation and raises tightening risk, pushing yields up and equities down. A cool print suggests easing pressure, inviting a relief rally. When you read CPI, compare both headline and core across MOM and YO to see whether inflation is accelerating or cooling. The jobs report isn't just a single number. The headline NFP shows how many jobs were added or lost. The unemployment rate, U3, tracks the share of people actively seeking work without a job. Then check average hourly earnings, AHE. That's a direct signal on wage pressure. Strong job growth plus rising wages can fuel inflation, keeping central banks hawkish. Weak jobs or soft wages reduce inflation risk and can support risk assets. Watch the trio together. Robust NFP plus lower unemployment plus hot AHE is a classic hawkish mix. Cooling jobs and wages point toward a dovish path. Markets trade the gap between expectations and reality. Know the consensus estimate and, if possible, the whisper, the unofficial number traders expect. The size of the beat or miss often drives the initial reaction. The bigger the surprise, the sharper the move. But don't stop there. Revisions to prior months and the composition, e.g., full-time versus part-time, goods versus services, shelter and CPI, can flip the story. A headline beat with weak internals may fade, while a small miss with strong internals can rally. Always read the fine print before committing size. Translate the data into a quick playbook. Hot CPI NFP usually means yields up, USD up, and growth stocks under pressure as discount rates rise. A soft print often brings yields down and a risk-on bounce, helping duration-sensitive sectors. But the open can be noisy. Liquidity is thin and algos dominate, so watch for a fade or reversal in the first 15 to 30 minutes. Let the market pick a direction, then look for pullbacks to key levels to join the trend, rather than chasing the first spike. Before the bell, run a fast dashboard. Check index futures, DXY for dollar strength, and 2-year/10-year yields for rate expectations. Then scan sector leaders and laggards to confirm the macro story. Is strength concentrated in defensives or cyclicals? Mark your spot levels, the overnight high/low to frame range extremes and VWAP to gauge fair value and intraday bias. If price holds above VWAP with supportive breadth, bias long. Below with weak breadth, bias short. Keep it simple, repeatable, and data-driven. Keep your note crisp. Start with the print and context. Core CPI plus 0.3% MOM, via 0.2% expected. YOY 3.8% vs 3.7%. sticky services. Next, state the immediate market reaction with numbers. 2-year yield plus 8 bits per second, S&P futures minus 0.6%, DXY plus 0.4%. Then add a bias, key levels, and invalidation. Bias. Sell rips below 4,500. Watch 4,472 VWAP and 4,450 support. Thesis invalid above 4,520 on breadth expansion. Finish with catalysts. Press conference timing, auctions, or Fed speakers that could shift the tone. Remember the core signals. CPI equals price pressure. NFP equals labor heat. Together, they shape rate expectations. Always compare the print to consensus and note the whisper, rather than your feelings. Size your risk only after price confirms. Let the first push settle, test levels, and show follow-through. Check yields, dollar, and sectors for confirmation. If the story changes on revisions or internals, be flexible. Clean process, clear notes, disciplined execution. That's how you turn macro volatility into opportunity.